Next Global Financial Crisis by www.forexconspiracyreport.com. Which directions will currencies and economies go before and after the next global financial crisis? MarketWatch thinks that diverging strategies of central banks have serious ramifications and will be responsible for the next global financial crisis. Since 2009, the key driver of financial markets has been liquidity. All asset prices have been affected by the central bank's attempted reflation. According to one estimate, over 80% of equity prices are supported in some way by quantitative easing policies. Today, as much as $200 to $250 billion in new liquidity each quarter may be needed to simply maintain asset prices. But now the world is entering a period where monetary policy will diverge between central banks. This has implications for both markets and asset prices. In short, the issue is what will happen as the USA stops printing so much money, while the Europeans, Japanese, Chinese, and others continue quantitative easing. After all, about $60 trillion in global debt is denominated in US dollars. What happens if the supply falls while demand goes up? When liquidity goes away, everyone, it seems, expects the US dollar to keep rising against other currencies, especially when the Fed finally raises interest rates. That will likely be a drag on the US economy as US products are priced out of global markets. The Telegraph warns of a liquidity drought and market bloodbath. Evaporating liquidity and higher U.S. interest rates will cause huge market swings with potentially catastrophic consequences, Institute of International Finance warns. Investors face a painful adjustment in a world of evaporating liquidity and higher U.S. interest rates that will trigger huge market swings with potentially catastrophic consequences, the Institute of International Finance has warned. Timothy Adams, the chief executive of the IIF, which represents the world's biggest banks, described liquidity as the top issue at high-level meetings of central bankers, chief executives, and other financial institutions. He warned that the raft of regulation introduced in the wake of the 2008 crisis could potentially cause market gyrations larger than last October's flash crash in U.S. Treasuries. If there is no credit, businesses do not grow and economies suffer. The thinking here is that the fact that the U.S. is no longer printing so much money is going to cause the next global financial crisis. Long-term or short-term on the dollar. The U.S. economy is still outperforming other major economies, and the Fed will likely raise interest rates. This will drive the dollar up in the near term. But what happens as European interest rates rise? Of particular interest is the euro and trade between the USA and European Union. However, Reuters reports on rising European yields. The US dollar hit its lowest level against the euro since late February on Wednesday after a rise in European yields drove demand for the euro, and weak US data supported expectations that the Federal Reserve will delay hiking interest rates. European yields continued to climb, with 10-year German Bund yields hitting their highest levels of the year at 0.6%, DE 10YT = RR. The rise alleviated concerns that the yields could hit negative levels after falling to a record low of 0.05% last month. It's clearly what's helping the euro along here, said Thierry Albert Wiseman, global interest rates and currencies strategist at Macquarie Limited in New York, on the rise in Bund yields. Are higher yields a result of less money to lend? Perhaps the next global financial crisis is closer than anyone thinks. For more insights and useful information about trading Forex, visit www.forexconspiracyreport.com.